guys and girls? Welcome back to another BMO video. Today we're going to be looking at the Purchasing Managers Index, also known as the PMI data. I'm sure we've all seen this on the calendar, but you may not know what it means and how to apply it. See, the thing is with trading, right, is it's all well and good knowing what a figure means. Oh, what does inflation mean? Oh, it means the change in price of goods. Okay, fine, but how do I trade that? That's the important part in trading, and that's what you're going to be learning with us in your trading journey. So in terms of PMI data, let's have a little look as to what it is. So firstly, PMI is a forward-looking indicator. So see lagging or leading versus lagging indicator videos or video for more information. It is on the website. Please check it out if you want a bit more information on what a forward-looking indicator is. But it gives us a view on economic strength or weakness within a specific sector that is likely to be in the future. So is this sector starting to fall? How much does that sector contribute to the economy? If that sector contributes a large amount and we see weakness, what do you think that happens to the currency? Again, these are questions you have to be asking. It is a survey that purchasing managers, so what they tend to be is like the head employee who sort of buys the goods and services for the company. It could be a manager, whoever basically goes to other sort of companies and buys goods for their own company. And of course, it's in different sectors such as the services, manufacturing, construction, etc. There's a couple of others there. They answer questions about employment, prices, new orders, supplier deliveries, production output, and inventory. So it captures a largely amount of data there and views. I can't remember the exact figure off the top of my head. I think it was like 400 companies or something like that. That the survey sent out to, and of course, whoever sort of buys the services and goods for their own company, they will answer questions about employment. They'll answer questions about how your price is, how your orders, are you getting new orders, how are your deliveries, how's your production like, what are your inventories like. So this gives us a lot of view on that specific sector, and this is why it's really, really important to watch this data and to understand it. A PMI number over 50 means expansion, and a figure below 50 means contraction. PMIs are good since it gives a quick and easy to read snapshot of how this specific sector in the economy is doing. Like I mentioned, how is the services sector doing? Just a quick, easy snapshot of the headline figure. So 53 for services PMIs. That gives us a snapshot of where have we gone from the previous month in the services sector to where we are now. You should use PMI data alongside other data to help get a confirmation. Just because PMI is above 50 doesn't mean the currency should strengthen. This is really important. Don't think like a robot and think, this 1 + 1 = 2. Obviously it does, but what I'm trying to get at is you don't just think one-sided and linear, one straight line. You think, okay, PMI is doing this or it's saying this, the underlying data is doing this. Okay, let me look at inflation data. Let me look at the employment data. Let me look at growth data. Let me look at what the central banks are saying, sort of what the theme of the market, what's sentiment like, is there any wars happening, is that political? Again, fundamentals is very difficult, don't get me wrong, but if you really want to take your trading to that next level, and in quotations, think like a bank, this is how they do it in those institutions. They're not sitting at charts all day, drawing lines on a chart. They're doing a lot of work behind the scenes in terms of their thought process and their views. So if you want to trade the closest you can to a bank, this is the way to do it. Now, just a summary of what services and manufacturing are. These are the two main ones you want to be focusing on, is services and manufacturing. There are going to be some economies that do not have, let's say, manufacturing data. It might have a composite data, so a broad-based figure. You just have to see which economy has it. I can't remember all of them off the top of my head. But if you don't see any, let's say you're looking at Trading Economics or whatever site or service you want to be using to get your data, and you say, let's say this economy over here doesn't have manufacturing PMI. What do I look at? You look at the services, and maybe it has like a broad-based one, like composite, so it compiles all of it together into one rather than separately. So you'll just have to see which economy has specific ones. Really, they might be named slightly different, but overall if you understand what's the underlying or the components under that, you would say actually there's more manufacturing, or actually there's more services. Now, services PMI is going to be the most important PMI sector for you to watch in G10, as services make up most of the economies. Some economies may have more services percentage terms, but will be above 50%. What I mean by that is the economy might be made up 55% services. Well, that's still a very large chunk of the economy. So if you're seeing services sector within that economy fall, that's going to move the currency, and that's going to move the sentiment, especially for other economies where there's like 75% weighting, massive amounts of weighting on that services PMIs then, isn't it? Manufacturing may not be as important. And that's why you sometimes might see that there's not really any reactions to manufacturing PMIs. That's because the markets actually care more about services, because services make up a large majority of G10, a very, very large majority. So here's an example, actually. According to the ONS, so the Office for National Statistics, the services sector made up around 79% of the total UK economic output and contributed to around 83% of employment in April to June 2023. So as you can see, if we have a contraction in the services PMIs, this won't be very good for the UK and the pound as a result, as it will likely entail weak employment and growth and a more dovish central bank. So again, it all works with each other. What's the most important factor for you to learn is the basics of fundamentals, because everything else just adds to the basics, doesn't it? It all adds to what interest rates are likely to be. It all adds to the inflation narrative. It all adds to the growth narrative, the GDP. So if you understand the basics, all the other bits of data you'll be learning in the series of what's PMIs, what are rates, what are equities, what are commodities, how does this drive currencies, it all adds to that theme of the basics. So once you have the basics nailed down, your trading will become a lot more easier. So put a lot of emphasis into learning the basics, because once you learn the basics, it becomes way more easier. That was one of my mistakes in trying to learn so much other stuff all the time. I was neglecting the basics quite often. Eventually I got it, because, you know, the more you do it, the sort of easier it becomes, and then it naturally just comes to you. But if I were to start right from the beginning again, I would learn massively what is inflation, what drives inflation. I would learn massively what is GDP, what are the components of GDP. Okay, let me look at those data. What are interest rates? You know, what do they mean for the currency? Why they risen? I knew the most basics of that, but then I went, okay, I know the basics. Now let me go and broadly learn what PMIs are. And then I started to get confused. So please put a lot of emphasis into learning the basics first, and then move on to the more nuanced stuff like the PMI data, the NFP data, the jobless claims, the wages, etc. Because it all adds to the primary bits of data, which is the interest rates, the GDP, the inflation, the central bank narrative, etc. But as you can see, 79% of total economic output in April to June. It's going to fluctuate, of course, but generally it's a large amount in the UK for sure. So you now know, okay, I'm seeing a contraction in the PMI data. That's why the currency in August, the pound in August, sold off so aggressively, is because we saw that contraction in services PMIs, and the markets did not like that very much, and they sold the currency off. And that's why you saw that pound GU, because at the time we were, of course, bullish the dollar in August. We were then bearish, of course, the pound in August as well. So GU shorts made the complete sense, and it sold off from like 131 all the way down to like 121, I think it was. So again, a large move to the downside. So here's just some examples of services sectors, and they include healthcare, again, self-explanatory, hospitals, etc., hospices, financial services, so banking, account management, anything along the lines of financial services, hospitality, so hospitality meaning restaurants, education services, so teaching, training programs, anything along those lines there in terms of education, IT services, so software, cloud, technical support, could be, you know, software engineering, anything along those lines is IT services. Media, what we mean by that is, of course, for example, like the cinemas, or you're going to watch a live show, that is media, or that's classed under the media category. And there's a lot more. Just all you got to do is just Google services, what makes up the services component of the economy in it. And there's a large list, but these are just some examples of services today. I'm not going to put all of it because it's just not necessary. You can go that and do that on your own back if you want to do that. But generally, It's financial services, it's hospitality, it's education, IT, media, etc., cinemas. Now, in terms of manufacturing PMI is another set of data for you to consider. You will likely put less weight on manufacturing PMI because it doesn't account for most of the economy. You should still look at the manufacturing PMI, but view it as, does it confirm the overall trend of the economy? I.e., are we seeing a contraction broad-based everywhere? Or is it just localized to the manufacturing sector? So the currency might weaken off slightly because of that, but it's not substantially going to weaken because the large component of the economy hasn't contracted yet. And that's why you might see, manufacturing has sold off, currency weakens ever so slightly, and then it rallies back up again. It's because services is still really, really strong. And that's putting upward pressure on, let's say, inflation, upward pressure on rates. That means upward pressure for the central bank to likely remain on the hold for longer. That's likely to be pretty good for the currency, especially when paired against people who are now slowing and have a much more dovish central bank. And that's, you might see that if you're ever wondering why it's not reacting too much to manufacturing PMI. It's because it's either one, it's been priced in, two, it's come at consensus, and three, it just doesn't have much weighting in the viewpoint of the market. Now, for example, the industry sector in China, so manufacturing, mining, construction, and utilities make up around 39% of their GDP. Yes, China is around 53% services, but the industry makes up a large chunk of China's economy when compared to the UK's measly 9% of that manufacturing PMI. This is why, even though China is slightly more services-based, the currency will still react aggressively to changes in the manufacturing sectors in overall. So how is manufacturing general doing? How's the mining? How's the construction? How's the utilities? The currency will obviously react aggressively to these changes as it contributes a large chunk to the economy. For example, we've seen this year manufacturing PMI in the UK trend lower, but the currency has actually been rallying this year. And that's because the services sector within the UK was actually really strong still. So the markets were just pushing aside. Sometimes they just don't care about manufacturing PMI. Sometimes they do. This is why you look at the reaction function. Again, I've made a video on that. If you ever do want a video and you're a bit confused on certain subjects, please feel free to reach out to me and ask me to add it to the list for me to make. We're here for you, right? So the more you want us to do, the better, because that means, more education. So that's what manufacturing PMI is. It's tangible assets, so physical. So whereas services tends to be more non-tangible, so not physical. So like financial services, banking, account management isn't a physical asset. Hospitality, in a way, you can argue that because you're going to a restaurant, you're eating there, blah, blah, blah. That's physical, fine. IT services, software, cloud, technical support, not really physical. Media, again, cinemas, etc. They are physical. And again, healthcare, again, hospitals, etc. They can be physical, but most of them, in terms of services, do tend to be non-tangible, and manufacturing does tend to be big physical assets. So let's just look at some examples of manufacturing sectors that you may want to be looking at. So number one, of course, automotive. I'm sure we all know what automotive means: cars, trucks, etc., bikes, physical assets. Textile and apparel, so clothing, footwear, etc., anything along the lines of clothing or making it for garments for people. That is obviously physical. It's not non-tangible. It's a physical asset. Food and beverages, obviously self-explanatory there. Not in terms of hospitality, but in terms of making those goods. Hospitality buys the goods of manufacturing. All manufacturing makes those goods. They make the boot. They make the food. They make the alcohol. They make the drinks. They make the Cokes. The Fanta, whatever. Those are physical assets there. Heavy machinery, so industrial, agricultural machinery, etc. So obviously that's self-explanatory. Aerospace and defense, so spacecrafts, planes, defense equipment, the list goes on. And furniture, self-explanatory there, sofas, chairs, whatever. And of course there's a lot more. There's a lot of sectors within services, a lot of sectors within manufacturing. I'm not going to go over them today because there's no need for me to do that. And I don't want to waste your time. Don't want to waste my time either. So again, just go to Google and find out for a massive list of what manufacturing or what sectors are within manufacturing. Now, a very, very important part of the video. This is probably going to confuse a lot of you at the start, but like I've mentioned many, many times already in a lot of the videos, is the more you do it, the easier it becomes. Think about when you learn technicals. It's really difficult at the start. The more you did it, the easier it becomes. It's the same with fundamentals. It's just that the fundamental learning curve is way steeper than technicals, because you can learn technicals within 6 months. And that's it. You don't need to learn any more because you learn what you know. But fundamentals, you're always learning something. You never know everything. And that's what I like about it, is because it's always a challenge. It's always something new that you're learning. So I'm not going to expect you to get it straight away. If you do, amazing. If not, just consistently try to learn what the sectors or what the components of PMI is. But some of us may know this already. But for those who don't, there are 6 components within PMI data you must look at, and each has a rating between 0 to 100. Again, like I mentioned previously, some companies, for example, like the S&P Global, they might look at some specific components of PMIs. Item services will look at others. They'll add on others. But generally, there are 6 components of the PMI data that you want to be watching. They might be named slightly differently, but they mean exactly the same. But they're given the same rating between 0 and 100. Obviously, anything above 50 is expansion territory. Below 50 is contraction. Some names might be different when looking at different companies, as I've just mentioned. But number 1, new orders. There's no particular order here. Each have their own views for that specific sector. And it's important to understand what they are. But as the name suggests, new orders look at orders received by businesses. If there's an increase in new orders, this tends to mean growing demand and potential expansion. A reading above 50 suggests that the economic expansion could occur, which has a knock-on effect to employment, growth, business activity, and overall economic health. What else do you think adds to this as well? If people are ordering more, what does that mean? Again, think about the basic stuff here. Everything boils down to the basics, remember. So if people are ordering more, that might mean better growth, better employment within that company, because if that company is earning more, they're likely to employ more because they want to keep up with growing demand. But that also means more inflation, which then means likely more hawkish central bank, which then tends to equal more higher rates. And if the currency is following the rates channel, that means higher currency or stronger currency as well. So that's basically new orders. Essentially what it is, it's just orders received by the businesses. Obviously, if we're seeing higher numbers, i.e. 55, 56, 57, 58, anything above 50 in the component of PMI, that's generally pretty good for that company, but also for the sector as well. Employment, as sort of the name it suggests, it's just the employment levels within the sector. An increase in employment is a positive sign for, of course, growth, as you know. A reading above 50 indicates that levels of employment are increasing. This is positive for growth, as more employment equals better growth and can mean potentially inflationary pressures ahead. And what does that mean? Markets see, there's a massive increase in employment. Maybe that actually bleeds through into other employment data. Maybe that means less unemployment rate. Maybe that means better NFP figures, higher NFP figures. Again, they all bleed through with each other. And this is why you're probably wondering, how do institutions say it's going to come out of this figure? Because they look at all of this data and suggest, based on their models, their machine learning models, whatever they use, it will spit out a figure, and that's what they use there. Because again, they've done their sort of maths. I'm not a guru at maths, so I can't exactly make one of them. But if you are able to make them, please make them, because they are very, very good to use. Now, in terms of employment, very self-explanatory. If there's better growth in the services sector, naturally, because that contributes a large, let's say, to the UK. If you're seeing good growth, that means probably better employment, better growth in the future. That means more inflation likely in the future. Not always one-to-one, remember, but this is the market's thought process. It's likely to be inflation pressures ahead. I've seen I've seen really good PMI data below CPI data. Better PMI growth data or employment data, better new orders, but inflation actually came in lower. So it's important to understand, why did inflation come in lower? Maybe it's because of it's getting dragged down by the, let's say, fuel perspective, or housing might have fallen drastically. Prices. So this is simply the change in price of goods and services. So again, pretty self-explanatory as well. If the price of your good is increasing, what does that mean exactly? So this is good indication of inflationary and deflationary pressures that may be building within the sector. A reading above 50 suggests that prices are increasing. This could be due to highest demand, could be supply chain issues, could be higher production costs, i.e. more expensive materials. Naturally, if you are a company and your materials are more expensive, you are likely to pass that on to the consumer, which means higher prices. So it's important to understand what is the reason why prices come in higher. But generally, what that means is more inflationary pressures likely ahead. Do you think a central bank is going to be fairly dovish in that environment? No, of course not. Why would they be dovish in a high inflationary environment, especially if new orders or if employment sector is good? Why would you be dovish? What's the point? There is no reason for you to be dovish. So again, it just prices pretty self-explanatory. Just think where people are paying more, that tends to mean more inflation. Supplier deliveries. So this is just simply the pace of deliveries within the sector. If the reading is below 50, this could indicate that deliveries are taking longer than usual. This can indicate, for example, supply chain issues, but can also be seen as companies struggling to keep up with increased demand within the sector. Again, that could also mean what? Again, it all tails in with each other. If this increases here, that probably means higher prices. If new orders are increasing, that's likely, employment might actually increase as well. Maybe not necessarily the employment perspective of PMI. I mean, it could, but generally that might mean more employment because companies expanding, and that's good for the overall sort of obviously the company wants to expand as big as they want, as they can. So they are going to employ more to keep up with that increased demand for new orders. So they all tail in with each other. So please do some more research. This is really important in trading. You need to do as much research as you can. There's only so much I know. I don't know everything. You're going to learn something that I have never thought about learning, for example. So this is why it's really, really important to just broaden your knowledge out. So that's essentially what it means is just the pace of delivery. So if you see supply delivery, just think how fast are they delivering that. And in terms of inventories, so as this indicates, it's just the level of inventory held by the company. How much are they holding on hand, basically? How many goods are they holding? This can give insights into how supply chain is performing and how well goods in general are managed within the sector. A reading above 50 can indicate businesses see potentially high demand in the future, potentially cheap pricing. So obviously what they mean by that is if inventories are really high, that could mean, as we've just mentioned here, high demand. So they're trying to keep that demand, sort of the supply levels high or the inventories levels high so they don't have issues with stock. Or if their inventories are high, it's just because, let's say, the materials were extremely cheap. Maybe you saw a massive slump in, let's say, lumber. So inventories might have increased very aggressively in the manufacturing sector because lumber's so cheap. So they're going to stock up on those really cheap prices. So again, important to understand what was the reason why these inventories rose. And the data the websites do tell you why inventories rose, why did prices fall, why did employment rise, etc. So it's not just, this figure's here, it's 50. Okay, what does that mean? The ISM services in particular, or ISM company, S&P Global also does have it, but I like how the ISM company, Institute of Supply Management, I believe what it's called off the top of my head. I might be wrong, but please don't scream at me. But overall, yeah, it just gives us an inventory level. A reading obviously above 50 can indicate businesses that see potentially high demand in the future, potentially cheap pricing, stocking up in anticipation of slowing production levels. For example, they might see that their production in the company itself is slowing. They might need to increase their inventories to cope with that. And of course, production output. This gives us an insight into how well production is within the sector. A reading above 50 suggests that operational production within the sector is good and tends to respond to higher demand for goods. This can also have a positive impact on economic expansion, because if production is good, you might not necessarily see specific names for whatever sort of company you're looking at. For you look at all the companies, by the way. You don't just focus solely on specific ones. You look at all of them. But let's say you look at New Zealand's PMI data. Supply deliveries might be called something slightly different. Production output might be called slightly different, but they all mean the same stuff. So if you are confused, it doesn't say supply deliveries. It might be just be named slightly different. But overall, yeah, it gives us a good view on how economic expansion is doing. So they all work with each other. Again, as I've mentioned, it all tails back to what is the theme of the market? What does the components of PMI drive? If employment is getting better, does that mean better growth in the future? Yes, likely. And what does that mean? There's more people employed. Maybe there's more spending, better growth, higher inflation, more interest rates, higher rates, or higher bond yields in particular, better, stronger currency. It's not always that one-to-one though. Trading is not always that simple. Sometimes it is that simple. It's just to see what is the theme of the market, how's the reaction function. We've made videos of all of what you need to know, and we're consistently adding more. It's just a matter of course, you just going through them and trying to expand your knowledge a bit further. But here's just an example of this is ISM services, by the way. S&P Global have it slightly different, but as you can see, what you're doing at is just looking at, okay, this is the overall figure. Has it trended lower? Yes. As you can see, they have a percentage change there, but it's trended lower since the previous sort of month here. It's trended lower. Business activity and production. So as you can see, that has fallen. Business production has fallen. New orders has risen, but on the ISM website, if you scroll down slightly more, it will have a new orders section below it. Just below here, it will have all sort of names. It will be like, oh, this is prices fell from this figure to this figure. They'll have reasons why it's done that. That's why I like ISM services, or the ISM company who does the PMI data, because they have that as well. S&P Global has it, but I like how they do the box, but then also a description below it. But employment levels fell in the services PMIs. Again, here's an example of divergence where employment actually fell, but new orders rose. Or employment fell fairly largely, to be fair to you, but prices stayed roughly the same. Again, there's going to be reasons for that. They do have their descriptions below there. I didn't put it in this PowerPoint today, but simply just go on the ISM services website or the ISM website, go to the services component, scroll down slightly below this box that you'll see, and they'll have all of the reasons there. Again, prices, as you can see, inventories there as well. That's going into contraction territory now. Supply deliveries is falling. Again, we've got all the reasons here. Supply deliveries, oh, that's fallen. Maybe there's a bit of supply chain issues. Maybe companies are struggling to keep up with the demand within the sector. It will have its reasons below there, of course. Now, here's just an example of US GDP growth rate versus the services PMIs. The US is largely services based anyway. So again, looking at kind of recent is a bit more difficult because we've gone from a huge, as you can see, growth rate is this GDP growth rate is this blue line here. The dotted black line is services PMIs. We saw a huge contraction, of course, COVID, huge expansion, reopening story, huge boom, bang, big sell-off. So the data is going to be choppy around these figures anyway. But generally, how the markets view it as you can see, kind of this is trended lower, growth trended lower here. This trended slightly higher. We saw a little bit of a bounce in data there. Saw a bit of divergence here. That's fine. There's going to be a reason for that. There's always generally a reason why the markets sort of diverge away. And then you can kind of see how it followed suit here. Expansion up. Divergence down here. This kind of marginally increased. This rapidly increased. There's going to be reasons why it's done all of this. But the general rule of thumb is if you're seeing PMIs good and increasing, remember, think about the direction of the data. That's important. The direction. Has it come from real contraction to really big aggressiveness in that data? Or has it gone from PMIs consistent being at high levels? And now are we starting to see that tail lower and lower and lower? The markets will trade this direction. Even at 50 levels, let's say here, the markets will be traded because if you want to be a bit too complacent, again, everyone has their own strategy. You're more than welcome if you want to be so very patient. But you are going to miss out on a lot of RR and a lot of moves as it trades into this level and below. Because now you're going to, this is, let's say if you're very conservative, this is May of when it goes below 50 is when you now sell the currency. But you've missed out on all of the move here that the market would have been trading because they saw that we went from expansion, we plateaued, we now start to see weaker PMIs. Let's say employment's falling. Now we're starting to see inflation fall, the headline figures, core CPI, etc. We're now seeing a more dovish central bank as a result of that, of course. They're not going to be hawkish in that environment. Currency weakens, we see bond yields fall, currencies fall in the rates channel, that equals weaker currency in the head. Again, there's a lot of difficult concepts for you to get your head around. Don't get me wrong, it's very, very difficult. But if you stay consistent with the learning curve, you will see results. It's just a matter if you want to do it or not. But again, this is just an example of it in sort of before pre-COVID, it has followed it fairly well. See a bit of divergence recently, but the markets understand that the correlation is still there, and that's an important sign for them to watch. But apart from that, hopefully you've learned something today. This is a revamped video, by the way. I did make a PMI video before that, but of course, as I'm learning more and I'm going through more in-depth stuff, I am going to naturally just revamp more videos because I can add more stuff in, right? But overall, the PMI data is a very, very important indicator for you to watch. Please look at it. Don't neglect it. Please watch it because it gives us a great indication of how is the service sector doing, how is the manufacturing sector doing, how is the components of that, because it tells us a big, broad understanding of how the services sector is doing. So you need to understand all of these concepts. But the most important thing for you to take away today is to understand the basics first before looking at all of this stuff, because you're going to get confused if you look at all of this and have no idea how it impacts the basic data. You understand the basics first, this will come a lot easier. Apart from that, have a good rest of your weekend or your day, or your afternoon or morning, whatever time you're watching it, and I will see you in the next video. Take care.